What's up guys, Jake here. In today's video, we're talking about individual stocks and potentially which are the best to buy right now. The reason why is because stimulus checks are going out this weekend. You get a stimulus check, you get a stimulus check, almost everybody gets a stimulus check. So the American Rescue Plan, I guess that's the name for it, was passed last week, signed by Biden, and there's going to be $424 billion worth of individual stimulus checks going out, totaling $1,400. All this other spending, you can bake it in. What's it going to affect the stock market? And my assumption is the stock market's going to keep going up. Yes, we bottomed out from the pandemic on March 23rd of last year, and the S&P 500 is up 76.25%. But I still think, even with the current valuations, just because so much money is being flooded into the markets, the S&P is going to keep going up. I easily think it's going to go over 4,000 in the next week or two. And if your current portfolio is heavy on these tech stocks from last year, think Microsoft, Facebook, Amazon, Tesla, Zoom, you might not do as well in 2021. There's kind of a rotation occurring. So the tech-heavy NASDAQ has underperformed the Dow Jones Industrial Average for 4 straight weeks so far in 2021. So once again, if you're holding all these stocks that went up huge, to most investors now, they're looking overvalued. They're looking overpriced. So people are looking for value stocks, for cyclical stocks, other industries that aren't as overpriced as potentially some of these high-growth tech stocks are. So let me give you 10 stocks that you can buy for exactly $1,400 that might be a good addition to your portfolio. As always, of course, this is not financial advice. Do your own research, listen to what I have to say, but make your own decisions. And before we get to the first stock, let me just show you how I evaluate stocks. And this is my basically 6-point criteria that I'd like to meet before I choose to invest in a stock. The first one is I like strong brand names. I don't like speculating on stocks that I've never heard of, penny stocks especially, IPOs, SPACs, whatever. So most stocks that I recommend and I choose are in the S&P 500. They're well-established companies that have been around for a while, a proven track record, a proven brand name. Number 2 is I look for revenue growth, especially over the last 5 years. If their revenue is stagnant or their revenue is declining, it's still possible for them to be a very profitable company. However, it just makes it harder. You want to see growth in a company before you invest in them. Number 3 is, do they offer a dividend? Now, I'll make the argument that dividends don't really matter. However, I view a dividend payout as a goal of the company to reward investors. When certain companies are growing rapidly, they don't care about the share price. They're not concerned about investors. They're just concerned about expanding. So once a company matures and starts offering a dividend, it basically changes their focus from growing the company potentially to appreciating the value of their stock. That's what I'm looking for as an investor. Number 4 is similar to number 3, but do they use company profits to buy back stock? When you buy back stock, you increase the value of the existing shares outstanding. So if the company is buying back stock, it drives up the share price because the equity of the company per share is now more valuable. Number 5 is, does it have a good price to free cash flow ratio? Everybody knows about the PE ratio, price to earnings. However, I think price to free cash flow is actually a better metric to evaluate whether or not a company is overvalued or, approximately valued well compared to their past history. Number 6 is the share price of the company currently down at all from its 52-week high, from its all-time high? Am I still getting a discount when the stock market has run up so huge in the last year? I'm going to show you a bunch of graphs. They're all from this website, macrotrends.net. It's a free website. You don't even have to register to use it and look up some graphs. The first company I'm recommending is Clorox, and this was an obvious play during the pandemic. You can see that around the March time, it shot up huge, and it was overpriced. So it peaked, I guess, in August, and it's been on a steady downslope ever since then. So the question is, its share price has fallen 20% since August. Is Clorox now a good value compared to where it was pre-pandemic? So PE 19.81%, dividend 2.35. It's down 20% from its high. And yeah, look at that crazy revenue growth the last 4 quarters during the pandemic. Now, investors are saying it was overbought, it was overpriced, their sales can't continue, it can't keep going up this much. However, I'm going to counter that. I'm going to say that with the pandemic, our sanitation needs and our sanitation habits have changed. Additionally, Clorox has really expanded their international sales, as once again, everybody is looking to sanitize everything to fight the pandemic. And when you look at their price to free cash flow, I didn't mention this, but free cash flow is really important because this is, let's go back to the definition real quick. Free cash flow is the cash a company generates after accounting for cash outflows to support operations and maintain capital assets. What does that mean? That means what money is left over to pay dividends, buy back shares of the company, make acquisitions, and reinvest in the company. So that's a very important metric to me. And when you look at Clorox's price to free cash flow, it's 17.5, which is down where it was in 2016, 17, 18. So in my opinion, this sell-off that's dropped Clorox by 20% now makes it a buy. Next company is Costco, and this is potentially one of the strongest brands in America. People love their Costco membership. PE is really high, 33.87. It does have a small dividend, 0.85. However, Costco share price only goes up, and it's currently down 14.74 since November 27th. And look at the revenue over time. This is very impressive. They did $178 billion in sales in the fourth quarter of last year. However, when you look at their price to free cash flow, I don't think Costco is overvalued. Currently 25.31, that's below where it's been trading the last couple years. And I think this sell-off is because, once again, people are saying, oh, everybody bought Costco because of the pandemic. It was allowed to stay open while everybody else was closed. So a lot of people are rotating out of this stock. However, I think this is a buy. I think especially at this price, being down almost 15% from its high, this is a good time to buy some Costco stock. Next company is Apple, and I know I told you I wasn't going to recommend tech stocks. However, Apple is the exception, and it's currently down 12.97% from its high. PE is rich, 32, but the PE is always rich for this company. And Apple, just, they did over $1 trillion worth of sales last year, 294 in the fourth quarter. Hey guys, I gotta pause the video because I just misspoke. Apple did not do $1 trillion worth of sales last year. That $294 billion is their trailing 12 months, the last 4 quarters combined. However, they did do $111 billion worth of sales in the fourth quarter of last year, which is insanely good. The fourth quarter always is a peak. It spikes because of holiday shopping. And Apple is just one of those companies that has a cult following. The brand, once again, along with Costco, is one of the strongest in the country. And think about this. All of Apple's retail stores have been closed for an entire year. All the malls being basically shut down. And they're reopening this week. I plan on visiting an Apple store next month. And I think there's a lot of innovations and things on the horizon with Apple. Their new M1 chip MacBook Pros and iMac desktops are coming out later this year. Additionally, there's all this rumor and buzz about a potential Apple car. I don't see Apple struggling this year or going down, so I think this is a buy at this price. Additionally, Apple is really good about using their free cash flow to buy back shares. Look at their shares outstanding ever since 2014. And their price to free cash flow is currently 26.02, and it is high. It is getting a little rich, which is probably what drove this recent sell-off. However, Apple has a lot of money. They have a lot of cash on the books. And Apple does this because they want to make acquisitions. However, I think with government scrutiny and regulations, they're not going to be approved. They're not going to let Apple just buy competitors or buy smaller companies. So eventually, Apple is going to have to use that cash on their books to buy back more shares or increase their dividend. So once again, Apple is a buy this year. Next company is Target, PE ratio 20.83, dividend 1.5. It's currently down 7.5% from its all-time high. And once again, the retailers that shot up huge during the pandemic, there's been a rotation the last 2 months, people selling off saying they're overvalued. Target, once again, great brand name. Huge revenue growth the last 4 quarters. Is it sustainable? I don't know, potentially. But once again, Target is using their money really effectively. They're buying back shares, making the existing shares more valuable. And their price to free cash flow isn't that bad. It's 11.49. So when you look at what they've been historically averaging or valued at, 2016, 2018, 2019, Target's share price currently is not overvalued in my opinion. Next company is another retailer, and this is Dollar General. I'll be honest, I've never shopped at a Dollar General. I don't think there is one in town, but it's a very popular chain, and their PE is currently 19.02, dividend 0.75, and they're currently down 13.42% from their all-time high. Look at this revenue growth for Dollar General, just slow and steady, very consistent. Obviously, it shot up huge the last 3 or 4 quarters during the pandemic. But once again, everybody's getting $1,600 stimulus checks. If there are purchases you need to make for yourself or your family and you want to be thrifty, where are you going to go? You're going to go to Dollar General. Additionally, Dollar General has been really good about using their profits to buy back shares. They don't seem to care if their share price is up or down or overvalued. They just keep buying back shares. Additionally, look at their price to free cash flow, 16.01. Now, yes, their last couple quarters were insanely profitable, which is what drove down this ratio, but it's still undervalued compared to where it's been 2017, 2018, 2019. So I really like Dollar General right now. Next company is United Health Services, and I feel like the healthcare stocks have taken a beating the last couple years especially. And United Health Services actually hasn't recovered from where it was pre-pandemic, and it was actually down to its all-time high in 2019. So the current PE ratio is 12.51, which is good. Dividend 0.58. They have been having consistent revenue growth. It looks like they haven't struggled at all with business the last 4 quarters during the pandemic. They're also doing stock buybacks, so the number of shares have been decreasing. And when you look at their price to free cash flow, 7.23, it's way down from where this company has been historically valued at the last couple years. So if you're looking for a healthcare stock to diversify your portfolio, I highly recommend United Health Services, ticker symbol UHS. Next stock is Bank of America, current PE ratio 20.26, dividend yield 1.9%. And you're not getting a discount with this stock. Its share price is at not an all-time high, but a high for the last decade, since the 2008 crash. And, this is contradictory, but their revenue is down because of interest rates dropping. They can't make as much money when they loan it out. So yes, their revenue has declined the last couple quarters. However, people are optimistic that because of risks of inflation over the next 2 years, that interest rates will have to go up, which will allow banks to make more money. So Bank of America was buying back shares the last couple years. They had to stop during the pandemic. This is, I think, required by federal law that the banks, because of the 2008 crash, they're not allowed to buy back shares if there's any kind of economic stress. But if you look at their price to free cash flow, it's only 8.78. It's close to where it's probably below where it's historically been averaged. This one data point from the 2008 collapse is skewing the graph, so it looks a bit wonky. But what I like most about Bank of America's stock right now is their chart, their technicals. They had a Golden Cross event where the 50-day moving average of their share price crossed above the 200, and it's clearly now in an uptrend. So look at this nice uptrending share price. So I see this continuing at least for the next couple months on this stock. Next stock is another financial, and this is Synchrony Financial, current PE 18.78, dividend 2.06. And once again, it's at an all-time high, so you're not getting a discount on this stock. However, I feel like amongst all the financial stocks, this is a pretty good one. Once again, revenue is down over the last 4 quarters, but don't let that scare you. As soon as interest rates go back up, this company will start increasing their revenue and sales. Additionally, they were doing stock buybacks with their profit, but they had to stop during the last 4 quarters because of the pandemic. I anticipate this will resume as soon as basically we're in the clear. Their price to free cash flow currently is 3.37. You look at where it's been valued in the past, it's been over 4 before. So I see this stock currently valued pretty well. And like Bank of America, Synchrony Financial is in an uptrend. So when you look at their stock chart, they had a Golden Cross event in October, and it's on a clear upward trend, probably going to continue the next couple months. Next stock is an insurance company, and I feel like because of the pandemic, people didn't know what would happen to the insurance industry, so these stocks were avoided for the longest time. However, Aflac has seen a nice rebound. It hasn't quite reached to where it was a year ago, and it's actually still down 8% from its all-time high. But current PE is only 7.77, dividend yield 2.55, and Aflac actually has flat revenue sales over the last 3 or 4 years, which is a concern. However, you can still be a profitable company and grow your share price even if your revenue is stagnant. Once again, I said it's harder but not impossible. But what Aflac's doing correctly, though, is they're using their profit to buy back shares. So you can see the number of shares outstanding has been decreasing year over year. Additionally, currently their price to free cash flow is 6.23, which I don't think is that overvalued compared to where it was pre-pandemic. And once again, the stock chart to me is just very impressive. They had their Golden Cross event in November, and now the stock is on a clear upward trend, and I see this continuing the next couple months. Next stock is another insurance company, and this is Allstate. They're currently down 7.83% from their pre-pandemic levels. PE is 6.69, dividend 2.88%. And unlike Aflac, their revenue has been increasing year over year, the last 5 years especially. And they're also using profit to buy back shares, making the existing shares more valuable. When you look at their price to free cash flow, it's perfect, 7.05. This is in the range of where they've been historically valued at since 2012. And once again, people just were wary of the insurance companies because they didn't know what effect the pandemic would have. However, like Aflac, Allstate had this Golden Cross event. The stock is now on a clear upward trend, and I only see it going higher the next couple months. So there you have it, guys. These are the 10 stocks that I recommend right now. When you add up the share price of all these companies, it's exactly $1,398.89, just under your $1,400 stimulus check. Invest it wisely, and I wish you guys good fortune. If you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel if you haven't already. I talk a lot about finance and investing topics. If you have any questions or comments or any stock picks or recommends of your own, let me know down below. I love hearing from you guys. Till the next video, take care.